Okay, welcome, ladies and gentlemen. Welcome to this week's episode. And what we're going to be talking about is two things, the only two things that's guaranteed in life, which is death and taxes. And this has come to me wanting to cover this week because, first of all, I'm at the age where you start thinking about building a family, having a family one day. And I feel like as a father, one of the responsibilities that you have, whether you're a father or a mother, I'm sorry for leaving you ladies out there. So let me rephrase that, is to leave something to your children that they could build upon and have a better life and opportunity than you did. And one of the scenarios that we see the most common with our clients is gifting a property to their children. And they always ask us, okay, is it worth us gifting a property to our children, or should they just inherit the property instead? Which one is going to result into the least taxes being owed? Because why is this important? You want to minimize taxes as much as possible because, first of all, as you guys can see, whether you lean left, lean right, Democrat, Republican, we can all agree that the government is very inefficient when it comes to using our money. So we want to minimize the taxes that we pay them, right? Because we can do more with our money than the government can. Also, number two is we want our children to have the most money as possible so that they can utilize that to build their wealth and then leave even more money for their children and the next generation. So, game that we had to play, right? How to give our children the most money and pay the less taxes possible. All right, so let's run through a couple of scenarios. So, what will happen if you gift your properties to your child? So, let's say you bought a property for $200,000 20 years ago, and now it's worth $800,000. Okay, so I want my team to build a picture or a graph right here. Okay, so 20 years ago in 2005, Sam and Susie bought a property for $200,000. Okay, now in 2026, it's now worth $800,000. Okay, they have a child. Let's call that child. Her name is Bianca. Okay, they want to gift the property to Bianca. Well, if they gift that property to Bianca, they are going to transfer the cost basis, which is $200,000, to Bianca. If Bianca sells that property, she would get taxed on the $600,000 of taxable capital gains, right? Versus if she inherits the property, she could potentially pay zero in capital gains tax. So you might be asking, okay, how do I do this then? How is that possible? So this is called a strategy called step up in basis. So when you inherit a property, let's say Sam and Susie pass away, and then when they pass away, their fair market value of the property is $800,000. Well, when Bianca inherits that property, her basis becomes $800,000. So the capital gains goes out the door, right? So she's avoiding capital gains on federal, which could be, depending on your tax bracket, it could be 0%, it could be 15%. And top earners might even have to pay 3.8% on top of that, which is called net investment income tax. And in addition to that, if you are in a high tax state like California, you will also have to pay state taxes, which could be as high as 13%. But for the most part, California, let's say that you're not that high of an income earner, so you will get taxed 9.3%. So by you doing a step up in basis, you're able to avoid a big tax bill from the federal and the state side. We see this a lot with our married couples also. For example, I remember last year we did a tax plan for a client who lives in New York, and this client who's married, they bought a property back in the 1960s for $40,000. Can you believe that? Can you imagine buying a property in New York for $40,000? So anyway, now that property is worth $1 million. So without a step up in basis, they would be subject to the entire $960,000 of taxable capital gains. But what happened was the husband passed away in early 2000s. I think it was like 2005 he passed away. So during that time, the property was about $500,000. So what we did was we got an appraisal for how much the property was worth in 2005 when our husband died. We were able to increase the basis from 40,000 to 500,000 because the wife was selling the property in 2025, which is last year. So we wanted to decrease the capital gains as much as possible. So step one is we did the step up in basis as part of our tax plan, and we were able to eliminate half of the taxable capital gains right off the bat. And then after that, we were able to increase the basis even more, or should I say, we took into consideration, accounted for the capital improvements that the property had from after 2005 to 2025. They had about another $200,000 of capital improvements during that time. So we were able to increase the basis by another $200,000. So just by doing those two things, we were able to increase the basis from 40,000 to 700,000. In addition to that, she had lived in the property as her primary residence 2 out of the last 5 years. So she qualified for the $250,000 of capital gains exemption. So we were able to wipe out her entire capital gains by doing that simple tax plan. Also, another situation where inheriting a property versus gifting a property is more advantageous. It's when you do a 1031 exchange. So remember, when you do a 1031 exchange, you're able to defer capital gains and also you're able to defer depreciation recapture as well. What's depreciation recapture? That is when you are taxed at 25% for the depreciation that you have previously taken on the property. And that's something that a lot of CPAs and accountants don't take into consideration is that when you take a depreciation, that's great because you're able to take a paper deduction, a paper expense, which is not an actual expense that comes out of your pocket, but it's still a tax deduction. But what they forget is when you sell the property, you now owe the government 25% on taxes on that depreciation recapture. So go back to my example about 1031s is that one technique or strategy that real estate investors use is called the swap until you drop strategy. And what happens is that every time that you do a 1031, which is when you exchange like-kind properties. What is a like-kind property? It's when you exchange, let's say, an investment property for an investment property. Well, you're able to defer capital gains and you're able to defer depreciation recapture, like what I just mentioned a few minutes ago. And then you just keep on doing that until you pass away. And then when you pass away, your children inherit that property and they get a step up in basis, which eliminates the potential tax liability from the capital gains of the 1031. So to make it simple, you are accumulating capital gains when you do a 1031, but you kick it down the road until you eventually croak over and die. Then when that happens, when your children inherit the property, they get that step up in basis, and then the capital gains just disappear. Okay. So if you have any questions, if you are concerned about gifting a property to your children, does it make sense? Will they get taxed? Will you get taxed? Please schedule a call with our team. And don't worry, your accountant handles that.